Thank you for joining us today. My name is Janie Sacco, and I'm the Outreach and Marketing Specialist with the Seattle Small Business Administration District Office. We're here to talk about how to get funding and resources for your startup business. We're going to cover the topics of how to start, grow, and expand your business, and from time to time, recover if necessary. So starting your business has a lot of components. One of them is the resources that we have in your community. There are a number of district offices throughout the U.S., and we have over 1,400 partner offices nationwide to help you in your process to start your business. You can find those resources by going to sba.gov/local-assistance. You do need to make a determination of which resource partners are right for you and make a determination of their role to see if it's the best fit. Our resource partners give you the opportunity to go through your business plan, review your financial statement documents like your expense sheets, your balance sheet, your income statement, and your financial projections. They will give you advice on how to improve the presentation and overall goals of starting your business. The first resource partner we're going to talk about is SCORE. So the Senior Corps of Retired Executives. It's a group of business mentors that are throughout the U.S. Our local Greater Seattle chapter information is provided here. But if you are outside the Greater Seattle area, you can go to www.score.org and make a selection by your area, and it will give you the ones that are closest to you. We also have the Washington Small Business Development Center. And what I'd like you to do there is go to their website and select the Small Business Development Center officer that is closest to you. We also have the 833 number embedded in this presentation so that you can contact them and set up an appointment. The difference between SCORE and the Small Business Development Centers typically is that the SCORE counselors tend to work with businesses that have been not in operation at all, and you're just starting, all the way up to about 2 years. The SBDCs tend to work with businesses that have been in operation for at least a 2-year time frame. However, there is a little bit of overlap between the two. The other resource partner that we have for you is the Women's Business Centers. And we have 3 in the state of Washington, and they're located throughout the state in Seattle, Lacey, and Spokane. Women business owners have this particular resource. However, if you don't have any other resources in your area and the Women's Business Center is available, you can check in with them even if you're not a woman-owned business. The last resource that we have is the Veterans Business Outreach Centers, and they're specifically for veterans of the U.S. military or a military spouse, and they provide counseling and transition assistance. They provide a number of training classes and referral sources and really get your business started as a veteran. So a very good resource for those of you that meet this category. The local Veterans Business Outreach Center is located in Seattle, and it's housed with Business Impact Northwest. You see the phone number and the website address for a resource in this slide. Now we're going to move along. Once you have worked with one or more of these resources to help get your business plan together, where do you get capital? Well, the Small Business Administration can help with that. The first thing that we want you to go through and evaluate is the 5 C's of credit. We're trying to help you determine your credit worthiness before you go to a financial institution. So the 5 C's are capacity, cash flow, capital, collateral, and character. When we're talking about capacity, especially for a startup business, we want you to think about having at least 2 years of recent industry experience. The lenders are also going to look at your work history, your training, your education, and really look at your ability to make this business successful. But again, for startups, we really want you to have preferably at least 2 years of industry experience and have it be recent. That way you have fresh skills in your particular industry. The two exceptions to that are that if you buy an existing business and you have the seller stay on for up to a maximum of a 12-month period of time to help you transition, that period is considered training and adds to the industry experience. You will need to have some transferable skills that are relevant to that business in your work history, training, or education. The other exception is if you're going to buy into a franchise. Most franchise operations that are on the SBA franchise list offer a certification and training process, and that supplements some of the industry experience issue. Again, you still need to have work history, training, education, transferable skills that help you be able to demonstrate your ability to operate your business successfully. The next one that is equally important is the cash flow. For those of you who are startups, you're going to have to highly rely on your cash flow projection. And by doing that, what you're going to have is a 12-month cash flow projection broken down by month. And the second year of a cash flow projection, you can maybe broken down annually or quarterly or monthly at your discretion. But the most important thing about that is that you will have to have valid assumptions for all of your expenses and your revenue projections. So you want to talk about things like, who are my competition? How am I going to price point out my product or service in relation to the competition? What are the demographics of my customer base? How am I going to reach them? And all of those questions are answered numerically in the cash flow projection. So you want to make sure when you're putting that document together that you do a solid job of looking at your industry, looking at your competition, looking at how you want to penetrate your market, and also what your demographic is for your client base. Have that all come together. When a lender looks at that, they're going to put together basically a break-even analysis to make sure that even if you don't meet your projections, you still will have an ability to repay the debt you're requesting, pay all of your business expenses, and provide a living wage for you in your business. The next one is capital. Capital is a combination of the cash and or hard assets that all of the owners in your business are contributing to your company. So you have a variety of ways that's treated on a balance sheet depending upon the legal structure of your entity, but equity is equity. And again, that can be the liquidation of personal assets that you then convert into cash for the business. If you have hard assets like equipment, furniture, inventory, maybe you have a hobby business, now you're converting it over to a regular business, you can take that inventory at your basic market value or cost and transfer that hard asset into your business balance sheet. So equity is really important because with the SBA products, in most cases, you can have as little as 10% capital injection by you as the owner or combination of owners and borrow up to 90% of your funding need. So when you're looking at your startup balance sheet, what you're going to do is you're going to list your working capital needs for cash, your inventory costs if applicable, your furniture, your fixtures, your equipment, leasehold improvements, and you're going to list all of that on your balance sheet and get a total. That total then is your capitalization. And what you need to do again is have 10% of that at a minimum. Capital requirements vary from lender to lender. Some institutions for startup businesses would like to have 30 or 35% equity contribution or capitalization by the owner. Some financial institutions will allow you to have 10%. So and it could be anywhere in between. So what you need to do is talk to different financial institutions, both credit unions and commercial lenders, and test the water there and see which one aligns best with your needs and your capacity to start your business and get financing from them. With respect to collateral, this one happens to be the least concern because what the lenders are required to do in conjunction with an SBA product is they have to take all collateral that is available to an extent. The first thing that they start with is the business assets that your business has. For a startup, it will be a combination of, more than likely, the business assets, the hard assets that are being funded from the purchase of the loan, the funding from the loan, and a combination of your personal assets. If you have a home or a rental property, the financial institution may want to take a lien in that. Again, that is a competitive issue, and you should shop around to make sure that you are getting a good alignment with your financial institution regarding what you can pledge and what resources you have and their desire to do the loan. In the event you do not have enough liquidation value collateral to fully support your loan amount, the financial institution has the option of asking for a life insurance policy to be assigned for at least the deficiency between the loan amount and the liquidation value of the collateral that you are pledging. And in some cases, your financial institution may also require disability insurance to be assigned in the event this is the only source of income for you. In both cases, we want to make sure that the financial institution is covered in the event you pass away while there's still an outstanding balance on the loan, so that the lender is fully satisfied with the loan amount. And in the event you are injured or cannot work and you have to exercise a disability policy, they will make sure that you have an ability to meet all of your minimum monthly payments personally and in the business. So that's how they shore up that collateral piece. The last one is character. That has to do specifically with each 20% owner in the business giving your lender the ability to pull a credit report on you personally. So your lender will do that. And what I would encourage you to do before you actually apply with the lender is to go to Experian, Equifax, and TransUnion and pull a credit report on your own. And you are allowed to get at least one free credit report annually from each of these reporting agencies. You want to make sure that your credit history is as strong as possible. Again, for each 20% or more owner, the financial institution will pull a credit report on them. So when you are now approaching a lender, you have put a business plan together, you've put assumptions together for your capitalization needs, all the assets in your business, you've made a cash flow projection. In your business plan, you're going to be talking about all the people who are coming together to help you make your business successful, whether they're employees, whether they're fee labor, like professional practices for attorneys or accountants, CPAs, bookkeepers, anybody that you need to help your business be successful. All of that's incorporated into this plan and those financial documents at startup. So when you are ready to go and ready to get financing, most financial institutions for startup businesses will look to the Small Business Administration guarantee products to help them mitigate their risk on doing this loan for you. And the SBA products with an SBA guarantee offer you the opportunity to have competitive terms, a longer repayment period on the loan, which reduces down your monthly payment, and Again, you continue to have access to counseling and education over the life of the loan based on who your lender is and the services that we have in the community through SCORE, the Small Business Development Center, the Veterans Business Outreach Center, and the Women's Business Centers. So what happens really when a lender does a loan in conjunction with an SBA guarantee? What happens is they apply to the Small Business Administration for a guarantee that can range anywhere from 50% to 90% on your loan. What that does is it mitigates a significant portion of the loss risk to the lender, which then entices them to want to do the loan for your business when they would not necessarily do that on a normal basis with their normal underwriting criteria. So, what can you do with an SBA backed loan? You can start your business, you can purchase a business, you can get access to working capital through lines of credit or term loans. You can use the proceeds to purchase, renovate, or expand your facilities once you're in there and have a lease. You can do inventory purchase, you can do equipment purchase, you can do machinery purchase, you can purchase land to develop your commercial property as long as you meet the owner occupancy requirements, or you can purchase an existing facility to house your business. And then we have a vast array of international-based products that help you if you are exporting your product or service. So very broad use of funds, and the financial institutions will look to the SBA guarantee programs to help do a loan, again, that they would not normally be able to do with their standard underwriting criteria. One of the things that the Small Business Administration offers is a tool called Lender Match. If you go to sba.gov/lender match, a little bit of information about your business will need to be put in the data, and you describe your needs, and we have a whole host of lenders who review Lender Match, and it's a national base of lenders that review this, and typically within a 2-day period of time, the lenders review these and get back to you based on the information that you have put in about your business and your needs. You then have an ability to talk to specific lenders, make a determination about which lender meets your needs the best, and then go into the application process with that lender. It's a great tool, a great resource, and it opens up your ability to talk to lenders nationwide about your financial needs. So what types of loans do we have for you? Well, there are basically 3 major categories. We have the express loan products, we have the CAPLine products, and we have our basic 7A loans. The express loans have a slightly lower guarantee offered by the lender, and they come in at 50%. The CAPLines are specifically lines of credit designed to provide your business with access to working capital. We have a contract component, meaning that if you have the opportunity to take on one large contract, then this contract CAPLine program will enable you to expend money on labor, materials, whatever you need, prior to actually generating any work on the contract itself. It's a very unique and beneficial program to help your business grow at a more rapid pace by funding one product or one contract at a time. We also have the capacity on the CAPLines to do a seasonal line of credit, which means that you can have an increase in your CAPLine during your seasonal period. And then for builders of residential properties, we also have a builder CAPLine program specifically targeted for their needs and repayment processes. The basic 7A loans range from as little as $500 all the way up to a maximum of $5 million. There are a few exceptions on certain products and uses of money where it can be a little bit beyond the 5 million, but generally that's the rule. For loans that fall into the up to $350,000 loan amount, that is called our 7A small loan product. And the lenders go through a data input process and they come up with a minimum small business score. That has to be at least 155. That has nothing to do with your personal credit score. What it is it's a priority or proprietary database that the SBA has based on all the activity of its SBA loans historically. And creates a marker in its software analysis of the data that the lender is putting in about you and your business to make a determination if you will have a score of at least 155 or more. So each individual application generates its own score. If the score is at least 155, then the lender has done quite a bit of its underwriting already, and then they go through an abbreviated underwriting process. For standard 7A loans that are more than $350,000 up to that $5 million cap, the lenders use this program, again, to really do a loan that they want to do. They believe the borrower has the capacity to repay, but it simply does not meet their underwriting criteria for one or more markers related to maybe cash flow, capital injection requirement, collateral, or your credit history. So these are the tools that the SBA allows the lenders to do funding for you that they may not otherwise do. We're going to talk a little bit more about the SBA Express loan terms and conditions. Again, the maximum loan under the SBA Express product is $500,000, and that is combined with any affiliates that you may have. For most of you as a startup business, you just have one, so that affiliation rule doesn't apply, but this is incorporated into this particular product. If you do more than one loan within a 90-day period of time, the lender does have to do an adjustment to the guarantee fee that it charges you to do the loan, and they will work with you on that. Again, as I said earlier, under the SBA Express product, the maximum guarantee that the lenders can obtain from the SBA is 50%. And this is because the lenders are using their own loan documents. They're really relying on their underwriting criteria, and they are just making sure that this meets the SBA standards regarding the standard operating procedures that the SBA has outlined for the lender. There are ongoing servicing fees, which are indicated here in this slide, and I've given you a schedule of the SBA guarantee fee ranges based on the loan amounts. And that ongoing servicing fee this year of 0.55%, that is specifically paid by the lender to the SBA on a monthly basis. That 0.55% is an annualized ongoing servicing fee. So they only pay 1/12 of that amount based on your outstanding loan balance to the SBA for helping fund this program over its life. With the SBA Express product, it can be a line of credit or it can be a term loan. The lines of credit can go up to a maximum 10-year period of time. They can have shorter repayment periods. That's at the discretion of your lender based on your needs and your negotiation with them. For the term loans, you can see that you can use this money for working capital, asset acquisition, real estate acquisition, tenant improvements to a lease space, really any eligible business need, okay? And depending on what the use of the proceeds are, your maturity date may be different. So if you're looking at a combination of working capital or inventory use or asset acquisition, and it's a combination of those kinds of uses, your maturity date should not exceed 10 years. If when you're purchasing equipment or fixtures or furniture, and the IRS class for the asset useful life supports a longer useful life of 15 years or more, then the SBA loan maturity may be 15 years. For real estate, this is at the discretion of the lender and the appraised value of the property and the useful life as identified in the appraisal. But most real estate loans will not exceed a 25-year period of time unless there's a construction component in this process, and then it may be a little bit longer than 25 years. For tenant improvements, again, it's usually a 10-year maturity. And again, your financial institution has the ability to either go out to the longest maturity date tied to the longest life asset in your use of proceeds, or they can blend it and have it be a little bit lower. So this is something you will negotiate and work with your lender on if you have a combination of uses in the proceeds. For CAPLines, just as a little summary here, again, the maximum loan amount for a CAPLine or capital line of credit is $5 million. The guarantee percentage ranges to the lenders vary. For a loan amount of $150,000 or less, the maximum guarantee the lender will obtain on the loan is 85%. If the loan is more than $150,000, then the maximum guarantee is 75%. And what does this mean to you? Well, if you go back to a loan that is $100,000 and the lender is obtaining an 85% SBA guarantee, then the maximum risk that that lender has for default is roughly $15,000 on a $100,000 loan. This is a significant inducement for them to be able to do this loan for you, even though you may not meet their normal underwriting criteria. Again, the maturities on the CAPLine product will go up to a maximum of 10 years, except for the Builder CAPLine program. And that will max out at 60 months, plus the estimated time to complete the construction or rehabilitation of their project. So the Builder's CAPLine product is a little bit shorter. One thing that we have to emphasize here is that all of the CAPLine products must have an exit strategy. So you need to be working with your lender to make sure you have an ability to repay this debt at maturity. I just want to go over some of the basic terms and conditions of the 7A program products. And again, this loan maturity has to do with the use of the proceeds. So if you're using your loan for working capital, inventory, furniture, fixtures, equipment, and it's a combination of those uses, then your loan will not exceed 10 years. However, if you're using those loan proceeds for furniture, fixtures, equipment, and they may have a useful life per IRS purposes of more than 10 years, then the SBA can allow the lender to have the maturity go up to a maximum of 15 years on that particular loan. Real estate related products cannot exceed a 25-year period unless there's a renovation or construction piece at the very beginning of this. And then once the construction's done, then you can have a maximum amortization of 25 years. Leasehold improvements, fixtures, those kinds of uses cannot exceed a 10-year period of time. So again, if it's a mixed use and you have commercial real estate as part of the use of the proceeds, the maximum maturity may be up to 25 years or it may be blended. So interest rate opportunities on the SBA guaranteed loans is very broad. And it really is at the discretion of your lender to help you make a determination about how they're going to structure your loan and what interest rate formula they're going to use. Needless to say, what basically you have is an opportunity for a variable rate loan, which is what most of the lenders do when they're doing an SBA guaranteed loan. Or we do have the option of allowing the lender to do a fixed rate on your loan. Again, the pricing is at their discretion, and that is a competitive issue. We have different base indexes for the lenders to price off of. That is at their discretion, which indexes they want to use. The spread or maximum plus over the index varies depending upon the amount of the loan. So for most of you, you're probably going to have a loan that is more than 7 years. So if your loan amount is over, let's say, $100,000, $200,000, most lenders are going to do a prime plus 2.75 interest rate. And that rate can fluctuate over the life of the loan as frequently as monthly, depending on the product, or it may be quarterly, maybe semi-annually, and maybe annually, or less frequently. So you need to work with your lender to make a determination of what the spread over the index is going to be and how frequently that interest rate is going to change. Okay. One of the things I do want you to know is that when you have an adjusting interest rate loan, your payment will change over the life of the loan because prime is not static, typically over a 10-year or 7-year period. It will go up and down. And what the lenders have to do to comply with the SBA underwriting standards is they have to have that term loan be self-amortizing, which means when you make your last payment on that loan, it has to go to a zero balance. So the lenders will adjust your payments over the life of the loan based on changes in prime and how it impacts your interest rate. The financial institutions have very specific criteria that they have to underwrite to when they're doing an SBA guaranteed loan. One of the most important ones is that they have to demonstrate why they could not do your loan with one of their conventional products. And that rule is credit elsewhere. They have to show that you could not, at their financial institution, get a conventional loan to do this funding. They do have to go through and do a credit analysis to demonstrate that you have an ability to repay, that you have the skill base to operate this business, that they have structured the collateral within the allowances of the SBA. And again, that cash flow, you have to have an ability to repay that loan based on the assumptions made and a reasonability test. So again, we really engage the lenders to make sure that they are treating your loan for servicing and underwriting in the same fashion they would for any of their conventional loans. It's just that the SBA products allow the lender to have a little bit more latitude on the structuring of the credit. And again, for loans that are $350,000 or less, we do have the small business credit scoring model to help the lender get through the analysis a little bit more efficiently. For loans of $25,000 or less, there is no collateral required. The lender can request collateral, but the SBA allows for no collateral requirements. Okay. When a loan amount is more than $25,000, then again, the lender has to go through and look at the assets that are available in the business to support the loan. If there are not enough assets on a liquidation value basis to support the loan, then they have to look at the personal assets of each 20% or more owner who is going to be a personal guarantor on the loan. I'm going to say this again. If you have someone who owns 20% or more of the business, the SBA requires them to be a personal guarantor. That means that they have had to provide a personal financial statement and up to 3 years of tax returns so that the lender can evaluate their creditworthiness and their contribution to the overall financial strength of this application. Okay, so if there are insufficient business assets, then the lender will look at the personal assets based on the personal financial information provided to make a determination if there are any assets that they may feel comfortable taking to support this transaction. And then again, if there are insufficient assets on a personal and business basis. From a liquidation standpoint, they will take an assignment of the life insurance and or a disability policy based on the risk assessment of the lender. So the other thing I just want to let you know, if you are asked to pledge a personally owned real property, there is no minimum appraisal requirement mandated by the SBA. However, most lenders will utilize their own underwriting skills and conditions for their institution to make a determination of what they need to do to help validate that market value on your personal real estate. So that again gives some control and discretion to the lender in terms of how they're going to help underwrite that loan. Now, what we've gone over to the 2 point at this through the presentation is a conversation about the credit unions and the commercial banks and how they do their underwriting. If for some reason you do not meet the underwriting criteria of the general credit unions and commercial lenders that are in your community or on the lender match, and you still want to move forward with this, we have resources or resource partners in the community that we work with. They are called micro lenders, and they may be a resource for you for a loan up to $350,000. That maximum loan amount varies from lender to lender. They may be your first lender, they may be your only lender, they may be able to meet your growth needs for a significant period of time, but they're an excellent resource for you in the community. Not only as a primary lender initially maybe, but you can also utilize these micro lenders to provide financing for your business in conjunction with a credit union or a commercial bank. So you could have this layering of debt obligation to the benefit of your business to make sure that you have enough money to do your project successfully. This slide is the list of the micro lenders that are sourced through the SBA and work in conjunction with the SBA in one form or another. And they're not in any order of priority, but Business Impact Northwest, I've mentioned them before, they not only are a micro lender, but they house the Veterans Business Outreach Center and also one of the Women's Business Centers. Mercy Corps Northwest is again in our market area. They are in multiple states, but they provide funding on an ongoing basis to small businesses. And going back here, Business Impact Northwest may have other sources of funding that they can look at to help you, but related to the SBA product, their loan amount maxes out at $350,000. Mercy Corps right now maxes out at about $50,000. Then we have MoFi, which actually serves a broad number of states, including Idaho, Montana, Oregon, Utah, Washington, and Wyoming. So they're a really good resource again, and their website's there. And again, they provide funding for a variety of reasons. We have New Roots Fund. Again, that is serving businesses primarily in King County. And then we have SNAP Financial Access. They are serving businesses in Spokane County. Ventures is a nonprofit business that, again, provides funding. Their loan amounts, I believe, max out at approximately $35,000 to $50,000, but they are primarily serving businesses in King County. And then Evergreen Business Capital has our Community Advantage Loan Program. Evergreen Business Capital also provides 504 loans for equipment and commercial real estate. We have a few other what we call community development corporations in our state that also work with the 504 real estate and equipment acquisition program, and they are Ameritrust and The one we have in Spokane, I'm drawing a blank. I'll have to pass on that. But anyway, we do have 3 that do the 504 funding. And so they're a good resource if you need fixed asset financing. So once you get through the basic startup phase, which runs 2 years, then you're into growth and expansion. We're going to talk a little bit about that. So what I really want you to focus on is think about relationship building. And when you're growing and expanding your business, SCORE, the Small Business Development Center, the Women's Business Center, the Veterans Business Outreach Center, they can all continue to help you grow and expand your business. So it's not just a one and done type of relationship with them. You can go back to them and use them as a resource ongoing through the life of your business. And then again, you have the commercial banks and the credit unions, and you have the micro lenders that are out there that can help you grow and expand as your business does. And really, as you grow and expand, you may need additional funding. You may need to have changes in the funding and the use of the proceeds. Rely on these resources in the community to help you with that. The last component that we are in right now is to triumph over adversity in the recovery phase. And what we want to have you understand is that when some bad things happen, whether they're natural disasters or an economic disaster, that is an example of which is COVID-19, we just want to make sure that you understand the SBA has resources to help you in those situations as well. Statistically, approximately 25% of businesses don't reopen after they have a major disaster. And again, you're talking about things like flooding, hurricanes, tornadoes, all those things that basically have physical damage in your business. So the Small Business Administration has the Office of Disaster Assistance tools to help you with those type of events. And to prepare yourself, you can go to sba.gov/prepare and really think about how to help your business get through this process as successfully as possible. So the SBA disaster assistance loans cover real estate, personal property, economic injury, which we're in right now with the economic injury disaster loans, replacement of machinery and equipment, inventory, and they also help the active duty military. So it's an all-encompassing program designed to really help businesses when they are faced with a very bad situation, whether it's a physical or economic disaster. So that wraps us up. And I just want to summarize, we're here to help your business start, expand, grow, recover. And we have a multitude of products to help your lenders and the micro lenders meet your needs through each one of these stages. And you have my contact information here. But I do want to say that please feel free to reach out to our office, the Seattle District Office, at 206-553-7310. We are taking calls every day that range from a broad brush of, how do you help me now to how do you help me grow? How do you help me start the business? And we have a strong staff at the Seattle District Office that can answer your questions and help you meet your needs and get you on your way. Thank you very much, and I hope you enjoy the rest of the BizFair event.